What's up guys, it's James Allen, the out-of-state investor, and there's so much to talk about in today's video between house prices already starting to collapse, supply is building rapidly at the moment, and mortgage rates, well, we don't even know which direction they're heading in right now. They've been so volatile recently. Are they going down? Are they going up? It's hard to keep track of what's going on. We also need to talk about what the Fed officials had to say about the most recent inflation data and how that could affect the future of the housing market. But before I get started, do me a favor, support the channel and smash that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Today's housing market is changing rapidly. We've already seen the housing market pull a full 180 and change directions from a bull market to a bear market. We've seen the housing corrections taking place. We've seen the price drops taking place. We see the supply rising, and this has been taking place ever since mortgage rates started spiking in the month of May. Well, the latest information we have is that new listings are down currently 12% year over year, and this is the steepest decline that we've seen in new listings coming on the market ever since June of 2020, back in the pandemic. Now, homeowners don't really want to sell their house right now because of what's known as the lock-in effect. Okay, they're already locked in to these all-time record low mortgage rates, so why would they want to leave that when they're going to have to get something like a 5.5% interest rate if they're going to go buy another house? At the same time, homeowners know that right now demand is not what it used to be. 4 or 5 months ago, you would get multiple bids on almost every house that came on the market. Today, it is not the same housing market. In fact, we can get a good grasp on where everybody is at mentally regarding today's housing market looking at the Home Purchase Sentiment Index by Fannie Mae. This gives you a good idea of how people feel positively or pessimistically towards the housing market, and we reached the lowest levels of the Home Purchase Sentiment Index since 2011. So this indicates that a lot of people don't feel like this is a great time to buy, and because of that, if you're trying to sell a house, you're not going to have nearly the same demand today as you used to have 4 or 5 months ago. We've seen more and more buyers backing out, and a big part of that has been affordability being at the worst place we've seen since 2006. We've even seen that according to Google, the term homes for sale was searched 23% less than last year at the same time. So this creates a problem because on one hand, buyers don't want to buy, and on the other hand, sellers don't want to sell. So what that means is that housing transactions as a whole has been crashing. But with that said, demand is going down so fast that it's causing supply to go up, and so even though the new listings is down 12% year over year, active listings as a result is still going up very fast. Now, all of this has begun to affect the median sales price. Now, you'll probably see many reports talking about how median sales price is actually up 8% year over year. Sounds pretty good, and even though we're used to seeing double-digit growth, it doesn't really hurt to see 8% year over year growth, but the reality is from the peak that we saw in the month of June, actually the nationwide median sales price is already down 4.1%. But with all that said, there are some optimists out there that are hoping that maybe things can turn around in the housing market, that maybe with mortgage rates having declined so much recently, we can see some more demand come back to the housing market, maybe balancing some things out and seeing some stabilization taking place. Well, it hasn't been long enough to determine which way mortgage rates are even going to begin with. We've seen them be so volatile recently, jumping as much as almost 0.5% in a day, and it's doing this over the past couple weeks, and so we really don't know if they're going to continue to go lower, if they're going to stay put where they're at, or if they're going to go higher again. What we do know so far is that since mortgage rates have gone down about 1%, we've seen demand stabilize. Instead of going down week over week over week like we've seen for about the past 5 weeks, we're finally seeing some stabilization as far as demand is concerned at least. Right now, we're currently sitting at about 5.2, 5.3% as far as mortgage rates are concerned, and as far as demand goes, about 2 weeks ago, we saw mortgage purchase applications go up 1% week over week, which seemed to be promising and maybe a change of trend taking place. However, we got the most recent data that as of last week, mortgage purchase applications actually went down 1% week over week, basically seeing a stabilization taking place, and in reality, we're actually down 19% year over year. So at this point, we have very limited information to work off of, but what it seems to be is that it's not really having much of an effect as far as bringing demand to the point where things are going to go up again, but maybe just slowing slowing things down to where demand is not going to continually spiral down. We did see some positive signs as far as pending sales goes. We saw the first significant uptick in over 5 weeks. That was good. However, we are still down 16% year over year. We also saw the amount of houses that go under contract in a week or less go up, and this was the first significant uptick we've seen in that category since around February, March time. Regardless, what I think is going on is we've seen a period of time where we saw house prices surge at ridiculous rates, and then we saw mortgage rates go up faster than I've ever seen before, to the point where it's been compressing house prices faster than we've seen in a long time. So now with these mortgage rates coming down, hopefully it's just going to calm everything down to maybe where we're still going to see some corrections in prices, but maybe at a much slower pace. But one important thing we really need to consider is the overall health of the economy. Now, on the surface level, things do seem to be pretty good. We see the unemployment rate as low as 3.5%, which is a historically very good number to be at, the best we've been at basically since 1969. Inflation data was recently released for the month of July, showing an increase of 8.5% year over year, which sounds bad, but it's actually on the downward trend from where it was in June when we hit 9.1%, and this has led many experts to believe that we finally hit the peak point of our inflation, and now we're heading in the right direction, starting to go down. Now, as far as month to month, from June to July, we actually didn't see any change in inflation. It was a 0% change, and so between the month to month change, between the fact that the annual inflation is going down, I think there's a lot of people starting to believe that maybe the Fed might make a U-turn and change their plans of quantitative tightening sooner than later. And so we saw the stock market soar on the day they released that information, and I think it's because some people are expecting the Fed to slow down on their rate hikes and maybe pull a U-turn sooner than later as far as their monetary policy. Well, top Federal Reserve officials actually signaled after this information was released that they expect interest rate hikes to continue well into 2023. So this brings a lot of concern to the economy, because if they continue to raise rates and they continue to offload their balance sheet and do all this even while inflation is coming down anyway, they're doing a lot of unnecessary damage to the economy and causing it to crash. And if we reach that point where we do hit an economic crash and we're in a recession and we see companies having to lay people off and people are losing their jobs, well, you can bet that's going to have an effect on the housing market, because it's going to take so many more buyers out of the housing market. So right now, things are really not looking good for the housing market as a whole. I think we got to pay attention to two things as we continue looking on, and that is the Fed's monetary policy. Do they continue to be aggressive? Do they continue to raise interest rates? Do they continue to offload their balance sheet? And secondly, what will happen with mortgage rates? Will they go back up again, or will they continue to go further down, making housing more affordable again, maybe bringing in extra demand? We'll have to pay attention to those two things, because that will indicate whether or not we're just going to see a housing market cool down, or if this is just the beginning stages of a much bigger correction down the road. So with that said, I hope you guys enjoyed today's video. If you gained some value today, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, give me your predictions in the comments below. Do you think mortgage rates continue to go down even further, stay the same, or do you think they're going to go back up again? Finally, follow me on TikTok and Instagram at The Out of State Investor. And if you enjoyed today's video, you're definitely going to want to watch one of these two videos right over here. And with that said, I'll see you guys on the next one.